Hello, all. Welcome to today's session on gold saving schemes and their tax treatment. Today, we have partnered with JAR to bring this webinar to you. In today's webinar, we are going to take a look at various uh, gold instrument through which you can make the investment and various aspects of tax on that gold. Now, today we have Gaurav with me. Gaurav is representing JAR. And in this webinar, again, Gaurav and I are going to take up how the gold as an asset class has performed and what are the different available options to invest in gold. It can be interesting investment in gold can be a very confusing situation because there are a lot of instrument available in respect of gold. So to talk us through that, Gaurav is here. Uh, we are going to talk about investing in gold, taxation aspect of the gold, and JAR is a new age app which has simplified investing in gold. But we have Rahul who will enlighten us in this aspect more. Over to you. Sorry, Gaurav. My bad. So, Gaurav, over to you.
Hey, hi everyone. So I'm Gaurav. I am presently working as a program manager in the founder's office of JAR. Let's look at how gold has been able to transition, how gold deeply rooted are we into the gold ecosystem entirely. So coming to the next slide, Saikat. Yeah. So the significance of gold is truly unmatched. It is something that is completely built, whether we see it as a savings option, we see it as an investment option, whether we see it as a tool, as an ornament, or maybe some relation connotations, some or a gift. So gold has something that has been a golden metal, which we have been using for investments for time immemorial. So coming to the next slide, what we see is that uh, the taxation on gold. So which is something
Correct.
which every one of us would be interested into.
Right. So basically, we are going to talk about the gold. What happens to the tax if you receive gold as a gift? Now, gold, since Gaurav said, gold has been integral part of our Indian lives. Right. Any kind of occasion, any kind of ceremony, we usually gift gold, right? So in case of marriages, what we see that bride and groom they get a lot of gold. There is a lot of gifting of ornaments, and every year without fail we purchase gold during our festive season, right? More specifically during the Diwalis. Now, that actually raises a question that what will be the treatment of tax in gift of gold? Now, if you are getting gift in form of gold, that falls under the ambit of gift taxation. Now, gold and gold jewelry has been specifically mentioned as movable asset which can be taxed, right? Whether it can be taxed as income from other sources, it can be taxed as capital gains. Now, gold has been given this special status. Now, how the tax on gold, how to gift on the gold? Firstly, if you are getting gold which is not more than 50,000 rupees, then there will not be any incidence of taxes. However, the 50,000 rupees will be seen at its entirety. For example, during a occasion, say for example, Dhanteras, you are getting gift of gold from your friends, right? There are four friends or five friends who are giving you gold. Now, each of these friends are giving gold worth of 12,000 rupees, right? So, if we look at individually, then 12,000 rupees well falls within below the 50,000 limit. But to determine the taxability, we need to see what is the entire amount of gift that we have received. So total amount of gift we have received is 60,000 rupees. Five friend giving me 12,000 rupees worth of gold. So the entire 60,000 rupees will be taxable in my hand. It will not matter that I have received this gold on occasion of some festivities. Only one festival or one occasion is falling outside the ambit of taxes, that is one's marriage. If you are receiving gold for the purpose of your marriage as marriage gift, then that amount of gold that you are receiving will not be taxed as gift tax. Secondly, if you are getting gold as gift from your blood relative, for your parents-in-law, brother-in-law, sister-in-law, both from your side and your spouse's side, so all those receipt of golds will not be taxed in your hand. Furthermore, there is a situation. See, gold has been embedded in our society, in our culture, in such a deep and meaningful way that we generally pass down gold from one person to another person through inheritance, right? So, if you are receiving gold through inheritance, there is no tax on one's hand. So I hope at this point of time we are very clear on how tax on gift of gold will happen. Now we are here to understand the return of the gold. Gaurav?
Yeah. So let's see as to, since we understood how the taxation on the gold looks like, so we also need to see how does the gold has performed as an asset class over years. We see that the inflation rate in India is somewhere close to around 4 to 5%. It ranges between 4 to 5%. Whereas gold has significantly given higher returns according to inflation, which makes it a very investable asset class per se, where you are beating the inflation and over and above that, you're making some returns. So this has been what gold is for us. What we could see here is that over the past 5 years specifically, and during the pandemic, gold has shined like a very great metal. It's something where we see that the investments in gold have been giving the returns to the upward of 12-13%, which is significantly high. So in pandemic was a time of distress. During that time of distress, we all tend to move towards the safe haven, and gold is considered to be the safest haven in the world. So that's the reason we see a lot of inflow in the gold towards when there is some economical turmoil, or if there is any geopolitical tensions, or if in case of any pandemic. So we see that investing into gold will actually help you beat the inflation. This has been the scenario globally. Now, coming to the other asset classes, like mostly we, as the Gen Z, we want to compare, like, okay, what is the kind of returns that gold could make when compared to equity. So we could see that it's a general trend in the industry, in the markets, that okay, whenever equity will rise, gold will fall, and vice versa. So the relation between the returns that we generate through on equity and gold is inversely proportional, and we could see that whenever there is in considering one's entire portfolio in a jiffy, what we could see that is having some amount of equity exposure and having some exposure towards gold could actually help you get better returns. And we also see that we can compare it in the next slide. We could compare through the returns of equity into with the returns of gold with real estate. We see that gold has significantly outperformed real estate. Though we can see that the volatility in gold is higher than real estate, where in real estate you get a kind of flatter returns, but it's gold that has outperformed real estate as well. So alternatively, traditionally, we as Indians, we have preferred asset classes which are actually tangible in nature. So gold is something that we could touch and feel, and that's the reason we used to buy gold. Same way, the real estate was something where you always thought that okay, whenever I want to invest something, I'll invest into a real estate. But you see that the ticket size for investing into a real estate is far higher, And also with this kind of graph, we could actually see that the returns that you were able to generate in real estate is actually lower when compared to gold. So it becomes a lot of sense for us to invest into gold. Now let's look at some of the investment options. Like, since we spoke a lot about what gold is and how gold has been able to manage and tackle inflation and is a safe haven, let's see at and look at what are the currently available options to us in India. So one way is to buy a jewelry. A jewelry is something where a lot of gold is used. Next is the physical gold. By physical gold here, I mean the bars, the coins that we can purchase from the jewelry shop. That's also a kind of good investment option. The next which we could look is the new popularization of the digital gold. Then is the gold mutual funds, which are also rising up due to because gold as a metal has been performing good, and this has interests a lot of AMCs to attract some of their investments into gold. Next is the gold ETFs, that is the exchange traded funds, and the newly formed the new product that the Indian government has launched. It's about the sovereign gold bond. Now, coming to the gold investment options that we just see is the physical form. It's the most traditional way how we have been investing. So what you could do is probably you go to your nearest jeweler, you go and you buy gold. May it any occasion, or may it you be buying into some SIP kind of a thing through them, where okay, probably you pay some 10, 12, 10, 11 months of installments, and the 12th month they will pay. Some sort of that arrangement is where we see the physical form. Now here, when we look at the advantages, these are actually, it's one of the convenient way to purchase, because that's the next door jewelry shop that you have, and you have a relation with them, so you trust them and you buy on them. In this case, it's also possible that you could buy it through cash. You probably do not require some digital or white money here to say to purchase gold. And maybe you could think about escaping taxation perspectives here, but then it's always recommended that you pay the taxation and get your gold with a receipt. And the liquidity of this form of a gold is the highest, because in the moment of distress, whenever you are in need of fund, you just have to step down to your nearest jeweler, and then you can get your investments liquidated. Now, see, there are investments into gold which have been proven advantageous, but I see that the problems associated in this kind of a method, when you particularly consider this as an asset class of an investment, is that there could be a threat of threat of theft. So here, what we see that 50,000 rupees of gold would be just say current prices of gold is around 60,000 per 10 gram. So a 10 gram is this much, and to get it stolen, it's very easy, and it's also very precious. So there is always a theft problem that is always associated with. What we also see is that there is a lot of making charges that actually doesn't make it the best investment option available out there, because in terms of making charges, what happens is, say suppose if you buy a jewelry's actual worth of that, say suppose if we take an example of a ring, probably you would be buying that for the ring's weight would be around 4 or 5 gram, but then the price that you would be paying for that ring would be somewhere close to 10 gram of the ring. So probably making charges is something that actually eats up into a lot of initial investment. So it's not the best form of investment that you should be doing. I agree that it is a convenient way, but the making charges eat up a lot of your initial capital here. Next is about since you want to hedge your risk against the theft, what you will do is you will probably buy a bank locker. And to maintain a bank locker, you must be aware that you would be requiring somewhere close to an amount, a fixed deposit amount, where the bank with the bank, so that they provide you with a locker. So there is a high cost of storage that is also involved, which we often tend to overlook when we buy a physical gold. And it is also you are not very sure, you are not very particularly sure, unless and until that jewelry is BIS hallmarked, where it states the purity of the gold. So you need to be very cautious when you buy gold, and that comes to our new I mean that, and also not only these, like there are also many tax aspects that are there on the selling of gold. I think Saikat can take it in the next slide.
Right. So selling of gold, yes. So since we have discussed that gold is considered to be a capital asset, so anytime you sell the gold, incidence of capital gains tax actually happens. Now, in India, as per the Income Tax Act, if you are holding onto an asset for a period which is more than 36 months, it will be treated as long term capital gains. Otherwise, it will be treated as short term capital gains. Excuse me. Now, the tax impact of these two type of capital gains, long term capital gains and short term capital gains, vary drastically with each other. So, if we are talking about short-term capital gains, the short-term capital gains is whatever amount you are getting from selling of this gold minus whatever amount you have paid to purchase this gold. Whatever the gap between these two amounts are, that becomes your short-term capital gains. Now, this short-term capital gains is taxed based on the slab rate. So if you have any other sources of income, say for example, you have some business income, you have some salary income, whatever it may be, and it finally pushes your tax slab to the highest possible rate, that is 30%, under both the new tax regime as well as the old tax regime. Whatever the gain you are getting, that will be taxed at that rate. Also, if your total income is more than a certain limit, you can face surcharge as well. And on top of that, you will be charged with health and education cess. So there will be a hefty amount of tax on sale of gold, right? Now, for short-term capital gains, the situation is a little bit more relaxed because the rate of tax, instead of charging you the marginal slab rate of 30%, there is a special tax rate of 20%. Excuse me. Also, since they are held for a long period of time, that is more than 36 months, indexation benefit is also provided. Now, what is indexation? This might be the question. Now, indexation, in simple terms, to to combat with inflation, income tax department usually allows you to uplift the cost of the asset that you are selling to today's standard. For example, if you had purchased a gold bullion, a gold bar, 10 years back, obviously you have paid somewhere around 35 40,000 rupees, but in today's standard the rate of gold is coming to 60,000 rupees per 10 grams, right? So there is a very huge disparity between the purchase price and selling price. Now, the income tax department, the government, actually allows you to bring the cost to today's standard. Now, each and every year, the department usually issues a indexation point, and you need to use that indexation point to get to know what will be the present equivalent cost of that particular gold. Right. For example, 10 years back, I have purchased gold worth 40,000 rupees, right? And in that period, the indexation point was, let's say, 200, right? And you are selling it off in financial year 23-24. And for this year, the indexation point is 348. So we can see there is a gap of almost 150%, right? So 40,000 rupees multiplied by 150%, that would give me around 60,000 rupees of cost of acquisition. Now, this cost of acquisition will be reduced from uh, the selling price of today's standard, and then whatever the gains that you are making, that will be taxed at the rate of 20%. So this is actually how tax on sale of gold happens.
Yeah. So now coming to the gold exchange traded funds. So the ETFs that we were talking about, this has been one of the very new initiatives that has been taken care by the AMCs these days. ETF is similar to your mutual funds, but what happens in the ETF and where it differentiates from a mutual fund is a mutual fund is something where it will not only be buying your units into gold, but it will also be putting some of its money into the gold mining companies or the companies that are associated with the somewhere into gold, right? So there are many advantages which an investor gets in an ETF product. So here the simplified thing is like an ETF. An ETF, you could have a very timely entry, and you could do an exit, and a small amount of money could also be invested into ETFs. It's as low as rupees 500, and then there are SIP options that are also available. And but there are certain restrictions of how much a individual can hold in terms of gold. So an investor can hold about a kg of gold, or and then he can opt for a redemption. That is, he can ask for a physical gold to be converted to be delivered at his place. But then here the only issue that we look around is the problems that are associated is that the returns on the gold is completely depend upon the performance of the fund, and that's where is our major lacking factor. So now coming to the another instrument where we actually do a lot of good investments, and we see that recently this has been a preferred way of investments into gold. So that is the SGBs, the sovereign gold bonds. So these are nothing but a bonds that has been issued by the sovereign guarantee, and it has been backed by the physical gold. So it comes into tranches every year, and then you have to actually wait for these tranches to open, and then only you can invest. Above that, the advantages which we could see here is that it actually gives you 2.5% more than what you get on the gold. Say, suppose we discussed that the returns on gold is somewhere close to 11.5%. But in an SGB product, the government gives you 2.5% extra over and above to invest into gold. Though there are some lock-ins that we need to also consider here, and then also there are some taxation aspects which I think Saikat can take it. Yeah.
All right. So tax on sovereign gold bond again, as it has been discussed that tax on the gold sovereign gold bond has been introduced by our government, and it is backed by our government, and it is issued in respect of keeping a physical gold. Now, taxation of sovereign gold bond is quite different than the normal gold aspect, right? So in terms of sovereign gold bond, instead of giving you gold outright, you are given a bond in lieu of the actual gold, right? And to keep the gold with the government, government actually issues a little bit of coupon, a little bit of interest in your hand, which is taxed in your hand, right? Now, this interest that you are getting, that is taxed at the rate of your marginal slab rate. Again, if you are being taxed at 30%, then the rate of tax placed upon it will be 30%. If you are taxed at 20%, then it will be taxed at 20%, right? And it will be increased by the health and education cess. Furthermore, these gold bonds are to be held till its maturity so that they become exempted from taxes. Now, gold bonds have this brilliant option that if you are holding on to them till its maturity, whatever amount of inflation, whatever amount of excess amount that you are getting, that will never be taxed in your hand. However, if you are selling them off before that expiry period, then the normal rates as per the capital gains taxes will be applicable on them. Right. So depending on the holding period, if it is held for a period greater than 36 months, 20% will be the tax rate after applying indexation benefit. If it is held then less than 36 months or up to 36 months, it will be taxed at the rate of slab that you are belonging to. Now, let's come to a very interesting topic, that is digital gold. Over to you.
So, digital gold is something that we have all been looking forward, and it's preferred as the new way to invest into the gold. So, the best part about the digital gold you could see is that you can buy fractional amount of gold, which was actually not possible. So this is a product where it gives you a lot of advantages over the all the traditional forms of investments that we discussed. We discussed about sovereign gold bonds. We discussed about the ETF. We discussed about how we should not be buying the physical gold, specifically considering the impurities, considering the high cost. So that's where a digital gold comes in. So to sort it out, to get the hedge from you, so to simplify for you, what a digital gold does is you buy a unit into that digital gold bullion, and in your name that would be part. So say suppose a digital gold is something where you can start investing into it as rupees as low as rupees 10, right? So it would be similar to buying your physical gold. So what will happen is a lot of this money would be pulled, and when one bar could be bought at that price, the bar would be bought. So the advantages of here, it's like it's very liquid. You could see that you can entry and exit at any time. And then when you buy a digital gold, say suppose by doing some fractional amounts, you are able to collect an amount where it comes to say suppose 10 grams or 5 grams, which is like a deliverable kind of an option, and you can always get it converted into digital, into a physical gold which you always wanted. This is a nice form of investing into gold, because specifically one can look at as a discipline as a disciplined approach where you could start a SIP, where say suppose a monthly every month you decide to do a 500 rupees SIP into digital gold, and accumulating all of this, you can actually convert your 500 rupees and someday get a delivery of physical gold. So these are the advantages of digital gold. But we also need to look at it that currently the digital market space is something that is not regulated. It doesn't come into the purview of either RBI or SEBI. And also it needs to be cautious. One needs to be cautious about it, that okay, there could be some intermediary costs that are involved, so the price of digital gold could sometimes be higher than what you see for a physical gold. Coming to the next slide, we could actually we have made a very beautiful comparison of as to how you can invest into jewelry can actually not be the best way to invest. So you see that the buying price, we have taken the study from November, December to January, and you could see that the average price back then was 5,500, which has now shot up to 60,000. So this is 1 gram of gold. So to buy 1 gram of gold, uh, you had to pay around 5,500 rupees, and then adding to the GST and everything and the making charges, your final cost of the gold could be 6,900 rupees. So there is a markup of 32%, which is the general standard that in the market that is prevailing in the market. So as I was explaining in the earlier slides, that okay, when you buy gold in the physical format, there is always a high cost of making charges that is associated. So it's always good that you shift into the digital gold ecosystem, and you see that the price differential is there significantly when you see compare it to the physical gold. But then there is no making charges that is here, and secondly the GST is the similar, and then the buy sell arbitrage is also not that heavy. You see that the buy sell arbitrage becomes very heavy in case of physical jewelry, because there is a making charges that is being involved. So it's always a good idea to buy fractional amount of investments into digital gold. Now, coming to the next slide is where we solve this problem of yours, where you could actually start your journey of investing into digital gold with as low as rupees one. Yes, you can save and invest into gold via a platform through the app known as Jar. You see that the withdrawals are as instant. So since suppose you would ask about the liquidity quotient here, we see that the liquidity is also instant. And also you could set up a auto pay mandate here, where every month or every weekly or even daily there are SIPs for it. Now, coming to the next slide, we have actually four offerings where we could see that, okay, how are we doing this for you? So you must be remembering the age when we were all young and we used to save money by having a piggy banks. So piggy banks was something where, okay, suppose if there was someone shopping into our family, they would give us the spare that is left. So this is exactly what we are doing in Jar. So we round off your digital spends and invest your spare into digital gold. Say suppose you did a Swiggy transaction of you bought your lunch, say of rupees 214 rupees. We'll round off to nearest 10, and that 6 rupees would be invested into digital gold. This is all happening passively without burning your pockets, and at the same time you're also investing some money into your digital gold. So this is one way where a roundup magic works. Next is the daily savings plan. Like you could actually set up a daily SIP kind of a thing where at the end of the day, certain amount which you decide could be deducted from your account and it would be transferred to your digital gold account. Next is you can also purchase, like say suppose it's a Diwali occasion where you understood that okay there are many advantages of buying gold online, buying it digitally. So then you can come to our platform and you can buy it one time. That is an option that is also available. Here comes an interesting product that we have just started. You see that the digital gold is anyway something which you don't hold it physically. Like you don't have the possession of that gold. That possession of the gold lies with us. So what happens is, what if we can give you an option where you can lease your gold, which is not even available with you, to a jeweler? That jeweler, like a SGB, could give you say 3% extra than what it is giving. So it also makes this product GoldX as a product which is more attractive than sovereign gold bond, because sovereign gold bond is giving you 2.5%, whereas this is giving you 3%, which is over and above 2.5% that is there. And also there are no lock-ins. Also, another feature of this thing is that you can get this money, the interest that you're earning, credited into your accounts every month. So that's also an advantage which we should look at when you buy gold from Jar. And you can lease it. You can lease as low as zero point 0.5 gram of gold to us. And then our jeweler, our certified partner jeweler can help you earn 3% extra. So overall, even the market is making 11%, 11.5% over a period of 10 years average, you will be making somewhere close to 14%, 14.5%. So it's an interesting proposition which we could look at. About talking about the taxation aspects, I can take it on the digital gold front.
All right, Gaurav. So the last option was really very interesting one, I would say. Now, taxation on digital gold. Now, taxation of digital gold actually works in two, three different ways. Firstly, if you are looking to convert your physical gold into digital gold, at that point of time, incidence of taxation would appear, and whenever you are taking that digital gold out to physical gold, at that point of time a transfer actually happens and incidence of tax arises. But due to this digital gold being more and more popular in this year's budget, the same has been granted an exemption status. That means if you are converting your physical gold into a digital gold, at that point of time, even though the incidence of tax happens, there will not be any tax collected. Not only that, whenever you are converting your digital gold to a physical gold, at that point of time also the incidence of tax will not happen. However, if you are selling the gold ultimately, that is, you convert your digital gold to a physical gold and you try to sell it or you sell it, at that point of time most definitely the incidence of tax will arise and you need to mitigate your tax liability as well. However, there is a good option, that is the period of holding, right? The period of holding will be counted from the day you have started investing in the digital gold. So for example, you started investing in jar from 1st of April 2023, right? After 3 years, say on 3rd of April 2026, you decide to sell this gold, right? So you don't do it automatically. What you do is you first convert that into physical gold and take the delivery, and after that you sell it off, right? The entire process takes another 4 5 days. Now, since you are actually selling off physical gold, people might be afraid that the holding period of this physical gold should be counted. Therefore, I must be holding it for another 3 years to get any long term tax benefit. But that is not the case. Keeping this thing in mind, the law has been amended to include the holding period of the digital gold as well. So, if you are purchasing a digital gold on 1st of April 2023 and selling it and converting it into a physical gold on, let's say, 3rd of April 2026, and after 2 days you are selling it off, it will still be counted as you have held it for more than 36 months, and all the benefit of long term taxation will be given to you. However, if you are buying digital gold and selling digital gold, in that case, the 36-month holding period will come to picture. And if you are holding on to the digital gold for a period in excess of 36 months, long term capital gains will be there with all its complications, all the compliances, that is, indexation benefit, etc. etc. If you are holding that for less than 36 months, then short term capital gains will arise and it will be taxed based on your slab rates. Now, this is how the taxation of digital gold actually happens. Now, this is a slide we have consolidated, wherein we are going to talk about all the items, right? So, Gaurav, let's go through them one by one.
Yeah, sure. So, like we looked about the physical gold, that's the reason we have kept it in the first column, because that has been the most preferred choice of the individuals to invest into. But we see that digital gold is slowly catching up the pace, and with all the taxation benefits that you just explained, I'm sure it's an interesting product that needs to be considered by all the investors. So purely talking upon the returns aspects, we could see that only when there is an escalation in the price of a product, whenever the golden metal moves, only then we would be generating returns. And we have seen that the golden metal has been able to generate a return of about 11.5%, considering 10 years of CAGR, which would hold true when it comes to physical gold. But then you also need to take care that when you are buying physical gold, probably you should not be buying it in the form of a jewelry. Rather, go it to buy in the form of bullion. That would be your coins or otherwise your bars. The next good option for you to invest would be digital gold, where in terms of returns aspect, the price arbitrage would definitely be here, since there would be cost involved. That would be your insurance cost. There could be vault cost, but then you would not be having any risks that you possess. You can rely on it because it's 100% hallmarked. Gold that we buy on your behalf. Next is the gold funds, and it would be actually there would be a certain percent of fund management expense that we also need to consider when you are buying gold fund, because this is the gold mutual fund. And here the company will not only invest into the gold as an asset class, but also invest into the companies that would be into the mining of gold or otherwise other related activities of gold, like leasing and all of this space. So here you have to be a little bit careful, and here your returns could significantly vary when compared to other investment options in gold when we are seeing. Next is your gold ETF. A gold ETF, the only differentiator in terms of return would be that it would be directly investing into the digital gold, into the gold itself. But also there would be some kind of expenses which you need to take care of. Next is your sovereign gold bond. Here you could say that, okay, on the surface it looks like the most viable option when it comes to a return, because you're not only getting what the appreciation of the gold would be, but also you will be getting a 2.5% return extra. But then there are a lot of complexities, like you have to hold it for a longer time, and so it is also an option which you could look at. In terms of purity, like I speak, physical gold would be the most vulnerable because you cannot be trusting the about the hallmark, and it could lead to trouble when you actually go and sell the gold. When it comes to digital gold, it's completely safe. Reason being, it is BIS hallmarked, and all the necessary precautions are always taken care of. In terms of gold funds and gold ETFs and in sovereign gold bonds, we need not worry about the purity because it has been taken care as it is completely done on the sovereign guarantee. About the taxation part, if you could take it, Saikat.
Sure, Gaurav. So I will just quickly go through the taxation aspect of various gold items. So physical gold, be it gold jewelry, gold bullion, coins, etc., etc. If you are holding them for a period in excess of 36 months, in that case, it will attract long-term capital gains taxes if you are selling it off with indexation benefit. If you are not holding them for a period in excess of 36 months or up to 36 months, in that case, it will be taxed based on the slab that you belong to. Now, digital gold, again, similar to normal gold, if you are holding it for in excess of 36 months, it will be long term capital gains, otherwise, short term capital gains. And on long term capital gains, indexation benefit will also be provided. Now, gold fund, gold ETF. These two are similar kind of thing. Not similar kind of thing. These two are also listed in stock exchanges. Therefore, tax treatment of them are of similar nature. So, if you are holding them for period in excess of 36 months, it will be long term and indexation benefit will be placed upon it. And if it is held for a period less than 36 months, in that case, short term capital gains and the rate of tax will be the marginal slab rate that you belong to. Now, sovereign gold bond, again, it has a tax advantageous position. If you are holding them for its maturity, till its maturity, there will not be any long term capital gains charged, but whatever interest that you are earning from it, it will be taxed in your hand based on the slab that you belong to. If you are not holding them for till its maturity, in that case, the normal long-term capital gains provision will apply. And if you are holding them for 36 months or more than 36 months, again, it will be taxed at 20% and with giving you indexation benefit. If not, then it will be taxed based on your slab. Now, Gaurav, can you please talk about the collateral?
Yeah. So when it comes to the collateral, this is something which is the most important aspects anyone considers before buying gold. Because in periods of distress or otherwise, whenever you're in need of fund, you look at your gold as which could be kept as a collateral and against which you could get some money. So here, the most acceptable form of gold which you could be seeing is that here your physical gold comes very handy because it is widely accepted by any jeweler or any pawnbroker or maybe by any credit company, right? So when it comes to acceptability as a collateral, here physical gold is the best option. But when you don't have any wish to keep it as a collateral, probably you could look at the digital gold as this is more safer. And what we also see is that even your gold fund, any kind of a digital gold which is not physically present with you, could be taken as like you cannot take a collateral against it. But here, sovereign gold bond is something that is an exception, and you can take a loan against your sovereign gold bond, and which is acceptable collateral. Next, we can come to like what are the kind of entry and exit points that one should be looking at. So you can see that anytime you want to buy gold, you can buy it. But when it comes to sovereign gold bond, you have to be very careful because when you want to invest into sovereign gold bond, it can only be done when the government issues the tranches, and these tranches have a frequency of about a quarter. So you have to probably wait And I think waiting to buy a product, waiting to investing is actually procrastinating, and you actually keep on delaying it. So better it is that you start your investments, you keep it disciplined, and you opt into options that are available for you to exit, for you to invest as an entry point. Also, while investing, the bigger thing that you could see is that while you invest, you always invest with a motive to take an exit and make some capital gains over it. So what is important here is not only the liquidity, but also when you can liquidate. So when it comes to all these kind of goals, like when you buy a physical gold, you can immediately liquidate it. You buy a digital gold, you can immediately liquidate. Similar is the case for your gold ETFs and your gold funds. So in gold funds, a typical of T plus 2 days would be something where you could get your investments back. But then when it comes to sovereign gold bond, in sovereign gold bond, there are certain restrictions which are always there. So when you look at as an investment option, you should always consider your entry and exit points to be very specific. Also, to come down to a storage cost that we were already mentioning, we see that the by storage cost, I here mean the locker cost, the locker charges, so that you don't end up losing your gold through theft or by any other chance, right? So since it's a precious thing, it's a precious investment for you, you need to keep it safeguarded. For you to keep it safeguarded, you have to pay locker charges, and which is the case in physical gold. But when it comes to digital gold, you do not need to pay any locker charges, and that's where you're covered. But when it comes to your gold funds and your gold ETFs, again here, since you don't hold the gold physically, you need not pay any storage charges here as well. In the sovereign gold bond also, there is no storage cost that is associated. We see that many of the investors ask a question that, okay, since you buy digital gold, by here do you specifically require a demat account? So to buy a digital gold, definitely you do not require a demat account. But when it comes to buying a gold ETF, a demat account is specifically required because all of your ETFs are stored in demat account and not there available with you physically. So here also there is a cost associated with the demat account opening, right? And always there is an annual maintenance charge. So it's a wise option that you can also like when compared to a digital gold versus a gold ETF, you could look at digital gold as there is actually zero cost associated here when it comes to the storage and things like that. In terms of when we talk about the regulations, you could see that all of these products are traded on the exchange, your gold fund and your gold ETF. So these are SEBI regulated, whereas the sovereign gold bonds are actually issued by RBI. So these are regulated by RBI. But we see that the actual comparison here when it comes to the regulations is about digital gold and the physical gold. As of now, none of the regulators have actually taken they have regularized digital gold, and we hope that it gets into regulation soon, so that it being such an attractive product, it also needs to be regulated, so that an investor can actually have a piece where, okay, they know that it's a regulated product and they can see a better and we can see a better traction in digital gold. And there is no way to regularize your physical gold. Maybe your bullion standards that comes into play, or otherwise your hallmarks can be a way, but there is no specific regulator who oversees what happens in the physical gold market. So here you are most vulnerable to as to the quality of gold. But and we can see that when compared to all of these options, we have a summary view as to what could be a perfect fit for you as an investor to invest into. So
Right, right. So now let's take a look at optimization of taxes whenever you are selling off gold. Now, firstly, we have to understand that whenever you are getting the tax, right, the incidence of tax actually happens. That actually happens on two times: at the time of getting a gift or at the time of selling off that gold. Now, at the time of getting the gold, all the other tax deductions under ATC, ATD, they are available. So we are not going to go through that. But at the time of selling, right, at the time of selling the gold, there might be some tax break which you can take, right? So firstly, over a period of long time, if you are holding on to gold, then it can give you a very good hedging opportunity, and it can beat the inflation in decent way. And if you are building your portfolio by allocating some amount of money in digital gold or physical gold, whatever it may be, it can give your portfolio a diversification. And as Gaurav has stated earlier, in the time of distress in the stock market, it has been seen that gold performs really well. So, if you are investing a certain amount of money in the gold, it can keep your portfolio afloat during the time of distress. Now, having said that, let's try to understand how the optimization of tax is possible. Right. So, firstly, whenever you are selling the gold, it can give you or it will give you capital gains. If it is long term capital gains, then in the previous years, if you have any type of short term capital gains, right, or long term capital gains, in that case, that loss can be carried forward to today, and whatever the gains that you have made can be used to set off that this year's capital gains. Now, it is to be remembered that if you are carrying forward long term capital loss, in that case, long term capital gain will be able to set it off. If you are carrying forward short term capital losses, then there is no restriction, no bar, you can set off any type of gains. So, it's a very good idea to also over here. I would like to mention one point that even though you are earning, you have got some losses in any other class of asset, say for example shares or mutual fund, that loss can be used to set off current year's gain that is arising out of sale of gold. There is no restriction on the asset classes so long the gain and loss falls under the same category. There will be no problem for set off. Now, another option for you is to invest in a purchase of house property, right? So, if you are holding on to a gold for a period of more than 36 months, it is treated as long term capital gains. And if you are investing that sum of money in construction of a property or purchase of a flat, in that case, depending on the money, the amount of capital money that you are investing, the amount of capital gain can be exempted. So under section 54, if what happens is, if you are investing the entire sum of money that you have received for sale proceedings as sale proceedings, if you are investing the entire amount, your entire amount of capital gains will be exempted. If you are using a fraction of that money, then in that proportionate capital gains will be exempted in your hand. So let's say you have sold a gold jewelry for 10 lakh rupees, right? And out of that, the capital gains is coming to 3 lakh rupees. And if you are investing only 5 lakh rupees, the capital gains that will be exempted in your hand is 1.5 lakh rupees. That will be in the similar proportion of amount you are investing. Now, I hope this actually cleared up your question regarding various type of gold investment and what will be their tax implication. Now we are at the end of the session and let's go to question and answer part. Gaurav, are we ready?
Yes.
Okay, so let's see if there are any questions. Right. So we have another 5-10 minutes in our hand. If you have any question regarding the entire presentation in terms of investment in gold, we can take those up. Right. So Gaurav, I actually have one quick question. That is one of the product that you have mentioned, that gold eggs. So if I'm purchasing gold, digital gold, and I have this option to lease it out to any other jewelry makers. So how does this actually work? And say for example, there has to be some sort of lease tenure attached to it, right? So I
Right.
can be leasing it for, let's say, 3 months or 4 months or 6 months even. So what will happen after 6 months?
Okay. So, say I'll talk about the kind of user journey which you could probably look here is, say, suppose you have 1 gram of digital gold. The bare minimum you need to lock in for this particular GoldX product is 6 months. So you lease out your minimum of zero point 0.5 gram for half a year, that is 6 months. Okay. What happens is when you lease out half a gram of your gold, this much of the gold would be lien marked. So we'll put a soft lock towards it where we not allow you to sell that amount of gold unless and until you have completed the 6 months. In all of this 6 months, you'd be getting that 3% every month. So this 3% is an annualized return. It is not a monthly return. This 3% you should be getting every month into your account, and once your 6 months of the tenure is over, you are available, your gold is available to you like how it would be. Say suppose it's the digital way of going into the collateral space, but here not looking at the collateral aspect but as an investment option where somebody else will actually be using your gold to get the jewelry made, right? And once your 6 months of tenure is over, that soft lock is removed, and you are free to again either reinvest into the another 6 months tenure where you could lease it for another 6 months, or probably you could leave it idle or even withdraw. So these are the kind of three options that you have when it comes to the GoldX product.
So Gaurav, we are getting one question.
Yeah.
So the question is there a possibility that gold is not available when I convert that into physical coin? Is there a risk on this?
No, there are no specific risk because what happens is in the background, whenever you buy a fraction of gold, at a fraction of digital gold, actual physical gold is bought in the background. So with the exact money of the physical digital gold that you buy, we buy a physical gold. So there is no possibility that we could run out of gold. So whenever you want, whenever you have a zero point 0.5 gram of gold or 1 gram of gold, you can get it delivered at your doorstep.
Okay. I think that addresses the question. Also, talking on that Gold X program, so you have mentioned that there will be a return of 3%, but you have mentioned that this 3% will be on top of the normal return of 11% or something like that. So in total, you were talking about 14%. Am I right?
Right, right. So it is up to 14% which you could see. Here 14%, 11 and a half, 11% is something where is the standard 10 years gold rate which we have. Actually, it's a 25-year average of the gold return, which we have considered. And over and above that, you're making 3%. So say suppose it is something that is actually giving you a better result when compared to a sovereign gold bond, where you don't even have to like invest waiting for the tranches to open. You don't have to do a higher lock-in of say 8 years. You can actually redeem it within 6 months, and also the interest that comes into your account, that is also credited every month. So it makes a very interesting product, and over and above that, you are getting 0.5% of extra returns. And here there is also, I would like to make yourself assured that okay, the gold that we have leased to the jeweler, that jeweler will not default because there is a bank guarantee that has been associated towards it. So it's a very safe and secure product, which is actually giving you at returns that are very higher when compared to any other gold options that are available currently in the market.
Now let's see if there are any other questions. Right. So there is no question coming up, and we can wait for another minute or so,
Sure.
and then we can wrap it up.
Yeah.
Right. So, Gaurav, I don't think we will be getting any question.
Yes.
Uh, it was our pleasure to be partner with the JAR, and it was wonderful talking to you and discuss and understand the nuances of gold investment. Thank you for your time. Thank you for working with us. Thank you for joining with us and share your understanding of the subject matter with our audience. Thank you so very much.
Thank you. Thank you so much, Saikat. It was really likewise a pleasure associating with ClearTax for this specific piece, and very happy to take any more further questions that any of our audience would have. It was pleasure speaking to you and to for our audience to understand the taxation aspects that has been their most favorite asset class over the years. So I'm sure it has been a fruitful session.
All right then. So Gaurav, it was very nice. So we are going to end this session. We are going to conclude this session. Thank you all for joining with us. Have a wonderful evening. Have a great evening. Bye.
Fine. Thank you, guys.